If you're a first-time home buyer, there are two types of mortgages that are the most commonly used for a home purchase. I'm Brand the Mortgage Man, and I've helped more than 10,000 home buyers over my 20+ year career in mortgages, and I'm here to help you. So the two types of mortgages that are used most often when purchasing a home as a first-time home buyer is an FHA mortgage with 3.5% down and a conventional mortgage with 3% down. Now, you may say to yourself, yeah, FHA mortgage, of course, it's for first-time home buyers. That's why it's called FHA. But believe it or not, FHA has nothing to do with first-time home buyer. It actually stands for Federal Housing Administration. It doesn't stand for first-time home buyer. But it is common because an FHA loan allows for a lower down payment than other types of mortgages. Now, we'll compare that to a conventional mortgage that allows as little as 3% down when you're a first-time buyer, just so you can compare and see what's going to work best or what might work best for your own scenario. So first, let's look at an FHA mortgage. FHA mortgage, as I said, is probably the most common type of mortgage that we see first-time home buyers looking into. And as I said, you don't have to do an FHA mortgage as a first-time buyer, but one of the advantages is that it allows for 3.5% down. Another advantage to an FHA mortgage is that it allows for a higher debt-to-income ratio. So it allows for a debt-to-income ratio up to 57%. So if you're not familiar with what a debt-to-income ratio is, of course, you can check out some of my other videos where I explain that in detail. But a debt-to-income ratio is your monthly income before taxes are deducted compared to your monthly expenses, which would include the new property you're buying. And that allows you to go up to 57%, which is considered high. FHA also allows for shorter waiting periods after any sort of credit issues, maybe like a bankruptcy or a foreclosure or a short sale, right? People experience those things. We as a lender understand that. And FHA mortgage is a great option if, maybe you're 3 years out from a bankruptcy discharge. FHA only requires you to wait 2 years, where a conventional mortgage would require you to wait at least 4 years, right? So you can buy sooner, you're just not having to wait quite as long. FHA mortgages are also more lenient when it comes to credit score. So you can go down as low as a 580 credit score on an FHA loan, where on a conventional mortgage, your credit score is going to have to be at least a 620 to qualify. And that doesn't even mean you'll qualify, well, nor does the 580 on FHA. However, those are the minimums, right? 40-point difference between an FHA loan and a conventional loan. Some lenders will actually go down to a 500 credit score on FHA, which requires a 10% down payment. Once again, it's not guaranteed you'd qualify, nor is any mortgage. However, the most common minimum credit score, if you're wanting to put 3.5% down, is going to be a 580 with just about all lenders. So these are the main benefits of FHA, in my opinion. And let me just give you an idea of what things look like if you're using an FHA mortgage to purchase a property. So let's just say you're looking at a purchase price of a home of $400,000. So we said that the down payment would be 3.5%. So let's do quick math on this. $400,000. Your down payment, which would be 3.5%, would be $14,000. Not crazy. Still, you're gonna have to save that up, but it's not a crazy number. It's somewhat affordable for most people. I'm gonna put here so you remember, that's your 3.5% down payment. If you're putting down $14,000 on a $400,000 purchase, that means your loan amount is $386,000, right? 96.5% of the sale price of the property. Now, something you might not know about when it comes to FHA mortgages is they have mortgage insurance. And you might be thinking PMI, because you might have heard that term, right? When you put less than 20% down on a property, you're having to pay PMI, which is private mortgage insurance. Well, the thing is with FHA mortgages, you have two types of mortgage insurance. One is called your upfront mortgage insurance premium, UFMIP, right? And this equals 1.75% of your loan amount. So we said your loan amount is $386,000, 1.75% of that. So what we do is we take 386,000 times 0.0175. This means you have an upfront mortgage insurance premium of $6,755. And you might say, well, what the heck is that? Where does that go? So you have two options. The first option is not very common. You can either pay this as part of your closing costs, right? That's option one, meaning that the amount of money you need at closing is $6,755 more. Or the common way to do this is this number gets rolled into this number. So that would give you we'll call it gross loan amount, right? Because it includes the upfront mortgage insurance premium plus your base loan amount. So technically your loan amount would be $392,755. So when you're getting an FHA mortgage and you're rolling in that upfront mortgage insurance premium, which there's no way to get around it, you have to pay that no matter what. Now you can negotiate a seller credit, and you can watch my videos on seller credits and seller concessions if you want to know how those work. So you can negotiate that as part of your contract and use that to pay it in full. However, the most common practice is just rolling it into the loan. We have $392,755 as your gross loan amount. Now, another thing on FHA mortgages, like I mentioned, there's two types of mortgage insurance, is your monthly mortgage insurance, right? So your monthly mortgage insurance is calculated based on your base loan amount, not gross. So that's your $386,000. This is what your monthly mortgage insurance is based on. So I'm gonna come over here. So we'll call it MMI, monthly mortgage insurance. To figure that out, right, you're putting down 3.5%. It's the same for anyone getting an FHA mortgage with 3.5% down. It does not vary based on your credit score. And I'm saying that because when I get to the conventional mortgage option, you'll understand why. So we have $386,000. We're gonna multiply that by 0.055, and we take that number divided by 12. So our monthly mortgage insurance is $176.92. This is your monthly mortgage insurance. So you're going to be paying this on top of the principal and interest portion of your payment, which is your standard mortgage payment. You're also going to be paying it on top of your property taxes and your homeowner's insurance. And if the property you're buying is an HOA fee, you're paying it on top of that as well. So we know mortgage insurance $176.92, which was based on the $386 base loan amount, meaning you're not paying mortgage insurance based on your gross loan amount, which includes the upfront mortgage insurance premium. Now, let's figure out the principal and interest portion of the payment. Your principal and interest portion of your payment is based on this number, the gross loan amount. So let's just say that the interest rate today is 6.25%, and that's a 30-year. Now, another thing I just want to point out is that FHA loans are not as driven by credit score. So you're going to be able to get the same interest rate on an FHA loan depending on the lender you're working with, whether you have 800 credit or you have 620 credit, right? So it's not going to be as much movement. You'll see on a conventional loan when I start talking about that, how much movement there is between credit scores. FHA, not the case. So if maybe you're someone who has a little bit lower credit score, let's just say mid 600s, an FHA loan is going to be a good option for you if you want to get a lower interest rate, and who doesn't want a lower interest rate? So we're going to take this gross loan amount at 6.25 over 30 years. And something I recommend if you want to do these calculations on your own, since I'm showing you how to do it, you can just, Google has a mortgage calculator on there. So you can just go on there and start playing with the numbers, get a general idea. I showed you how to calculate the upfront mortgage insurance premium, so you should be able to figure out what your gross loan amount is and work from there. But let's just say we take your gross loan amount over 30 years, 6.25 interest. So your principal and interest, in this case, would be $2,418.26 per month. Now we take this mortgage insurance, right? It's paid monthly, called it MMI. We're gonna add that to the payment, $176.92. Now, we're also gonna have property taxes and homeowner's insurance. So an HOA fee might be by homeowners association, depending on what you decide to buy, but you're definitely gonna have insurance because as long as you have a mortgage on the property, you're required to have homeowner's insurance, protects against things like fires and Florida hurricanes, right? You need to have insurance. So it's a $400,000 property. For now, let's just say insurance is gonna run you $400 a month. These are monthly figures. And then let's say your taxes are $600 per month. So to figure out your monthly payment, we're gonna add all these things together. $2,418.26 plus $176.92 plus $400 plus $600. So on this property, using an FHA mortgage, we're looking at $3,595.18 per month. That's your all-in monthly payment. Principal and interest, mortgage insurance, homeowner's insurance, property taxes, total monthly payment. Now, that's going FHA. Now, what we want to do is we want to compare to the other popular loan type, which is a conventional mortgage, putting 3% down. Now, here's the thing. I said we're looking at the most popular loan types for a first-time buyer. And the reason I said that is because 3% down is really only available on a conventional mortgage to a first-time buyer. And a first-time buyer is someone who hasn't owned a property in the last 3 years. Now, there is a way to put 3% down if you're not a first-time buyer based on that definition. And in order to do that, your monthly income, or your annual income, should be no more than 80% of the area in which you're looking to purchase the property. It's called your area median income. And I can share a link in this video or just below showing you how to look that up for yourself based on where you're looking to purchase a property. So it's really simple. But now we're gonna look at a conventional mortgage, putting 3% down, right? So we said we can do 3% down if you're a first-time buyer. You can't go higher than a 50% debt to income ratio, right? We said FHA is 57%. We're at 50% on a conventional, and it's going to require a 620 credit score or above to qualify, right? So there's some differences. Less money down, which is great. A little bit lower debt to income ratio and a little bit higher credit score is required. Now, I don't recommend maxing out your debt to income ratio, so I think that plays less of a role in determining what type of loan to go for, but you never know based on your circumstances, right? Maybe you know your household really has more income than what's being used to qualify, meaning that maybe you're married and only one of you, right, you or your spouse is going on the mortgage, and we're not counting any of the income for the secondary person in the household. So the high debt ratio might just be on paper, but not in real life because you truly have that extra income. That's a circumstance where maybe maxing out the debt ratio isn't as big of a deal. But just keep in mind, you never really want to max things out because we're qualifying you off your income before taxes are deducted. It's not actually what you're bringing home. So a 50% debt ratio for a mortgage is probably closer to a 70% debt ratio based on real numbers. So it doesn't leave you much to work with at the end of the month. But anyway, back to our conventional mortgage, right? So let's do the exact same purchase price. So for comparison, so we're doing $400,000. Our down payment in this case, right, is 3%, which is $12,000, leaving a loan amount of $388,000. Now, on the FHA loan, I said we have an upfront mortgage insurance premium. On a conventional loan, we do not have that. So your loan amount is your loan amount. You're not having to roll anything additional in there. You're not having to get a seller credit to cover it if you don't want to roll it in like on the FHA loan, right? What you're borrowing is what you're borrowing, right? Keep in mind, when on the FHA loan, you were putting down 3.5%, but then you're financing in another 1.75. So you're financing much more than 96.5% technically. You're financing closer to 98% of that property. So you have less equity in the property and there was additional cost to make that happen, although you put more money down to begin with. So here you're putting less money down, but your loan amount of $388 is still gonna be less than your gross loan amount of $392,755 on the FHA scenario. Now, here's a pretty cool thing with being a first-time home buyer getting a conventional mortgage. So I mentioned that you can do 3% down if you're not a first-time buyer and your income is 80% of the area median income or below. But using that same lookup tool, also that's gonna be down in my description below. If your income is 100% of the area median income or below, there's actually no adjustments to the interest rate if you're a first-time home buyer and meet that requirement, which is pretty cool. Which normally, if you watch any of my videos on how pricing for conventional mortgages are determined, it's based on your down payment, your credit score, the number of borrowers on the loan, the type of property you're buying, right? All those things are factors because those can either reduce the risk or increase the risk of the buyer profile or the borrower profile, and it has a direct impact on the interest rate on a conventional mortgage. However, if your income is at or below 100% of the area median income for where you're buying and you're a first-time home buyer, so you haven't owned a home in the last 3 years, you don't have any of those adjustments. So that means you're gonna get a much better interest rate than you would if you were over that 100% area median income or if you were not a first-time home buyer. So let's just say that the interest rate for this scenario right now, interest rates on conventional mortgages are higher than that of FHA mortgages. So let's just say the interest rate for this scenario is a 7%, and that's a 30-year. Not as attractive as a 6.25, but let's just see where it lands us. So 388 over 30 years at 7%. So your principal and interest payment is $2,581.37 per month. Now, just like on an FHA mortgage, we're still gonna have monthly mortgage insurance. It's called PMI, private mortgage insurance, when it's on a conventional mortgage. You're still gonna have taxes, you're still gonna have insurance. So we said the taxes were $600 per month. We're gonna use the same numbers because it's the same property. And we said insurance was $400 a month. Now, mortgage insurance, right? PMI. I mentioned for a reason that on the FHA mortgage, that the cost of the monthly mortgage insurance does not vary from borrower to borrower, regardless of their credit score. If they're putting 3.5% down, it's 0.55% of their base loan amount divided by 12 months. That does not vary. However, with a conventional mortgage, you actually have to qualify for the mortgage insurance the same way you're qualifying for any interest rate. So the cost of the mortgage insurance on a conventional loan can actually vary substantially. If you have lower credit score, you can be paying 1.8% of your loan amount for mortgage insurance. If you have great credit, you can be paying 0.15%, right? So it can be much less than what you pay on FHA, or it can be much greater than what you pay on FHA. So I'm gonna give you an example. Let's just say you have great credit, and we're gonna take this 388 loan amount, and we're gonna say that the mortgage insurance premium is 0.3%. So we do 0.003 times the loan amount, and we take that number and we divide it by 12. So in this case, the mortgage insurance is $97 a month. This is at 0.3, right? Is what we said the mortgage insurance rate was for great credit. But what if you don't have great credit? What if you're on the lower end of the spectrum? Let's just say you're at 640 credit, right? So to figure that out, we're gonna go ahead and we're gonna do your 388 loan amount, 30-year term. Actually, I'm sorry, 388. And we're gonna say your mortgage insurance can cost you 1.7. So I'm 0.017 divided by 12. So the mortgage insurance for the borrower with the less than perfect credit, right? We said this is at 1.7%, is $549.67 per month. So let's see the difference in monthly payment between the two. So we have 2,581.37 plus 97 plus 600 is another 1,000. So your monthly payment is $3,678.37 versus someone who has less than perfect credit. So we take the 2,581.37, which is the principal and interest. We add the mortgage insurance, which is substantially higher, 2,581.37 plus 549.67 plus the 1,000 for taxes and insurance is 4,131.04. Here's how you're going to compare what makes the most sense for you when you're looking at the most common types of loans used by first-time home buyers. You want to compare how much money you're coming out of pocket, and you want to compare what your monthly payment's going to be, right? So in this case, sure, you're putting less money down, right, by 0.5%. Nothing crazy. It's $2,000, right? In this case. On FHA, you're actually going to owe an extra $6,755 on this property, right? Than you would do an apples-to-apples comparison with the conventional option. However, if you have 660 credit, let's just say, right, or 640, whatever it might be, you're probably going to want to look at an FHA loan because the cost of your monthly mortgage insurance of $176.92 is nearly $400 less than the cost of the mortgage insurance on the conventional loan with that same credit score. However, if you have better credit, let's call it 780 or above, and your mortgage insurance on the conventional loan is only going to be $97 a month versus FHA where it's nearly $177 per month, well, in that case, a conventional mortgage is going to make more sense for you. So here's what I want you to take away from this. If you're someone who has better credit, and maybe you're a first-time home buyer, have not owned a home in the last 3 years, and your income is at or below 100% of the area median income where you're looking to purchase, I would lean toward a conventional mortgage with 3% down. If your credit is less than perfect and you don't meet the requirements for the 100% area median income, so on and so forth, then you probably want to lean toward an FHA mortgage because it's going to give you an overall lower monthly payment based on your circumstances. Another thing to factor in, you're probably looking at lower down payment options because you may not necessarily have enough money for a down payment plus closing costs. When you're looking at an FHA mortgage, I want to add one more benefit. You can request a seller credit, and I think I mentioned this briefly, to cover the upfront mortgage insurance premium, but it doesn't have to cover just an upfront mortgage insurance premium. Seller credits can cover your closing costs. And on an FHA mortgage with 3.5% down, you're allowed up to 6%, right? As long as this number does not exceed your overall closing costs. So on $400,000 at 6%, that means you can actually get a seller credit of $24,000, assuming you negotiate into your contract and the seller agrees. However, come over here on a conventional loan, you're gonna be a little bit more limited, right? So on a conventional loan, seller credit would work the same way. However, if you're putting down 3%, your max seller credit is also gonna be 3%. So 3% of $400,000 is $12,000. So this should likely cover all of your closing costs depending on where you're looking to purchase. However, if it doesn't and you need a larger seller credit to make the numbers work and make purchasing possible, then an FHA mortgage may also be the reason you want to look at an FHA mortgage. So you need to weigh everything. You want to weigh the interest rate, the monthly payment, how much money you're going to need in total for closing on the property, right? These are all factors you need to consider. If you found the information in this video helpful in making your decision on whether to go with a conventional mortgage over an FHA mortgage, then I've done my job. So make sure to subscribe to this channel for more videos just like this one, and comment below if you have questions about your own scenario. I reply to 100% of the comments left on my videos.